Hello everyone, welcome back to my tutorials. Yesterday onwards, I started Q&A session. Yesterday in Q&A session part 1, we discussed about the various components involved in prospectus. In today's video, we are going to discuss in this Q&A session part 2 about methods of venture capital financing. Before we discuss about the methods of venture capital financing, one should clearly understand what is venture capital financing. Before understanding the venture capital financing, one should clearly understand what is venture capital or venture capitalists. Who are venture capitalists? So first let us understand the concepts, then we will move on methods of venture capital financing. As per the request made by few of my students, they have brought few questions. I'm preparing videos based on those questions, and these are called Q&A sessions, and this is the part 2. So shall we start? Now let us understand venture capital. Before understanding the venture capital, if you can understand venture capitalists, who are the venture capitalists and what is their purpose, what exactly they do, you can clearly understand what is venture capital and what is venture capital financing. Okay, so there are basically three parties. The first one are the high net worth individuals who have surplus money, who are basically rich business people who have surplus funds. And the next one, banks. Obviously they have money and they use this to lend loans. Okay, and next comes Nbfcs. They are also called banks, but they are not called banks exactly. They are called non-banking financial corporations. I explained you the difference between banks and Nbfcs clearly in the class. If you can remember, comment in the comment section. I'll be very happy to see your comments and likes. I'll be very happy. Okay, anyhow, I'm not going to differentiate between banks and NBFCs. It will deviate our concept. I'm explaining you about the venture capitalists and venture capital. Then we are understanding venture capital financing. Okay, so what they do, the high net worth individuals, banks, NBFCs, they pool resources. Okay, or simply we say money. They pool money. Pool means they gather the money, and this is called venture capital or simply venture capital fund. What they do with this money? They create an organization. And dump this money in this organization. Why? Because there is a person, okay, there is a person who is an entrepreneur. He has bunch of ideas in his mind, very creative ideas, but he doesn't have money. So what should he do? If he go to this person, he will reject. First of all, he cannot contact this person. If he straight away goes to bank, then banks have a lot of legal procedures to grant loans. It will ask security, and he doesn't have security also to give. And most of the cases he cannot go to NBFCs also. Like banks, NBFCs also ask the securities. He is not able to provide the securities also, but he has bunch of ideas in his mind. Then what will he do? These persons pool resources and form the organization, and this is called venture capital. From this venture capital, he can easily borrow money. This is all about venture capital. Is it not easy to go to venture capital firm? It is actually called venture capital firm and borrow money. There are less legal formalities than compared to banks and NBFCs to borrow money from such kind of venture capital firms. So such kind of entrepreneurs, there are so many entrepreneurs in India till now who are suffering with lack of capital but have bunch of ideas in their minds. They are very creative persons who have bunch of ideas to change their fate and become a very good entrepreneur, but couldn't borrow any amount loan from any of these persons. For such kind of entrepreneurs, venture capitalists or venture capital firms assist either by participating as a management or by giving money to them and assist them to become the entrepreneur. This is all about the concept of venture capital, and pooling the resources and giving money to him is called venture capital financing. This is all about the venture capital financing. They are called the venture capitalists. This person bank Nbfcs, they are called venture capitalists. This concept of venture capital has come into existence in India from 1977. Predominantly, there are few institutes which participate in venture capital financing, like ICICI, IDBI, IFC, likewise. I hope you understood the concept. Now let us move on to the methods of venture capital financing. Now let us discuss about the methods of venture capital financing. These are the methods of venture capital financing. Before we understand the methods of venture capital financing, we should understand the meaning of venture capital, which I explained in this slide. You can easily understand with these two definitions I provided in the material. Let me briefly explain the venture capital in these 2 points. The first one, venture capital is a form of private equity financing. See, it is a private equity financing. It is not a public financing. Government will not provide, but private people, banks, of course, Nbfcs are involved in venture capital financing. That is provided by venture capital firms. See, these are the venture capital firms which like high net individual persons, banks, Nbfcs, who pool the resources and establish an organization firm. This is called the venture capital firm, and these venture capital firms are funds to startups, early stage companies and emerging companies, not already existing companies, not like Reliance, ITC or Coal India. They provide to startups, early stage companies or emerging companies that have been deemed to have high growth potential. If they feel these companies, emerging companies, have high growth potential, they will lend loans to such kind of entrepreneurs or firms, or which have demonstrated high growth. They will provide finance. Okay, I hope you understand. Watch video with keen interest. You will easily understand the concept. The second one, venture capital is long-term risk capital. It is not risk-free capital. It is a long-term risk capital. Venture capitalists, like these persons, venture capitalists, will take some amount of risk by lending loan to this person, entrepreneur, a startup companies, which of course obviously have high risk and of course growth also. Okay, so venture capitalists, venture capital firms have some long-term risk capital which is involved in financing high technology projects. Since they are high technology projects, innovative ideas which obviously have some risks, but at the same time has strong potential for growth. They take a risk, but equally they have good strong potential growth for success. And venture capitalists pool the resources. They pool their resources. Venture capitalists pool their resources, including managerial abilities. Not only the money, they even provide the expertise. CEOs, like CEOs or MDs, they will come along with me, they work along with me, they provide the managerial expertise also. Abilities to assist new entrepreneurs in the early years of the project. Once the project reaches the stage of profitability, they sell their equity holdings at a high premium and they make profits and go away from the company. Okay. This is all about the meaning, concept of venture capital. Hope you understood the concept. Now let us quickly understand all the methods of venture capital financing. The first one is equity financing. As I told you, venture capitalists create some shares, buy shares from the company. For example, I am the investor and I start to establish a company, Pawan and Company. But I don't have capital. I approached venture capitalists. They have participated in my company by creating some shares. For example, I have authorized share capital of 10 crores. 51% of shares should be held by me. I should at least contribute 51%. For example, 6 crores I should invest in my company. Remaining 4 crores are invested by venture capitalists, which is accounted to 49%. So majority stakeholder will be me. I am the majority stakeholder. They are the minority stakeholder because they have max to max, so 49% of stake. This is called equity financing. They are equal entrepreneur along with me because they have subscribed equity shares. They are the shareholders of my company. So they have long-term commitment in my company. Once my company establish after the startup, the infant stage, then I achieved the break-even point and positioned myself in the market, and once the growth has come, then they will sell the equity for profit and go. For example, they have subscribed how much? 4 crores. After 5 years, my company has grown. Growth happened in my company. Will the 4 crores be 4 crores after 5 years also? The turnover has increased. I have crossed break-even point. Sales increased. I have positioned strongly in the market. The 4 crores become 14 crores. Then they will leave my company by selling their equity at 14 crores. How much is the profit after 5 years? 10 crores. Okay, they make a profit and go away from my company. Okay, so this is a smart strategy. Venture capitalists will never fail if they believe in my idea, if they trust on me. If there is good growth in my company, then only they will invest in my company. After the growth, they will double, triple their amount. They sell their equity and get away from my company. That is one method or way of venture capital financing. These are the different ways of financing venture capital financing in my company. This is the first one, equity financing, first method. And the second one is conditional loan. Conditional loans are those loans which doesn't carry any interest, but I have to pay. Here in case of conditional loan, instead of interest, I have to pay royalty. You can pronounce this as royalty also. So what do you mean by this? Conditional loan which doesn't carry any interest, but I have to pay a royalty. See, for example, if venture capitalists have provided credit to me, just like banks, it will carry interest as per the interest rate prevailed in the market. For example, if it is 12%, I have to pay per annum 12% to venture capitalists. But these are conditional loans, which doesn't have interest, but I have to pay royalty. I cannot I cannot be very happy that I need not pay interest. I have to pay royalty to them. What do you mean by royalty? Royalty, you can pronounce like this also. Royalty means the amount to be paid to the asset owner as I'm using the asset. Okay, royalty is the amount to be paid to the person who has assets and I'm using those assets. For example, I have car, okay, and I'm not using this car. In the COVID-19 situation, from March, I'm not going to college, I'm staying at home only, I'm not going anywhere, and my car is idle in my compound. For example, if you have come and approached to take my car, and I asked why, you said I will use your car, my car for taxi, for commercial purpose. Then I lent my car to you. Car is the asset. Okay, I lent my car to you and I don't expect any rent on my car. Instead of that, I expect royalty. Okay, what do you mean by this? From revenue, okay, from revenue, you should pay certain percentage like 30% or 40% to me. Okay, this is called a royalty. Okay, this is called royalty. Under this conditional loan, venture capitalists provide certain amount. For example, I need 10 crores. Okay, 10 crores will be provided to me by venture capitalists. Instead of this interest of 12%, they expect a royalty, which is 40%, and I should pay this royalty from my revenue. My dear student friends, try to understand. I'm explaining in detail to you what is royalty. Okay, I need not pay interest, which is 12%, but I have to pay royalty from my revenue. So each and every year I need not pay. Once I start generating profits, creating a revenue, I have to pay royalty from my revenue 40%. In case if there is a delay, a gestation period has increased, then naturally the royalty rate may vary from 2% to 15%. Okay, for example, I promised venture capitalists that after 5 years I'm going to pay a royalty because I cannot generate any revenue in the first year, second year, third year, fourth year. I cannot generate any revenue. I will be in a break-even point, below the break-even point. I think you know about break-even point. After 5 years, I cross the break-even point and I start earning revenue. Okay, so after 5 years, I will pay you royalty. Okay, royalty some 40% or 30%. I will pay. Okay, if this exceeds 6 years or 7 years, we cannot expect anything. Now lockdown period is happening. If gestation period, this is called gestation period. If the gestation period increase, then royalty rate may vary 2% to 15%. It is neatly mentioned in your notes. Once you read after watching this video, my dear student friends. Coming to the next one, income note. I hope you are able to understand. I am explaining you in detail each and every minute details. Income note is a form of hybrid financing. It is a form of hybrid financing. What do you mean by this hybrid? It includes a traditional loan and as well as conditional loan, both. Simple. And the next one is participating debentures. Debentures are debt instruments. Equity is the ownership instrument. Okay, debentures are the debt instruments The one who provides debentures are called creditors. The one who provide or subscribe equity shares are called equity shareholders. I explained the first one, that is equity financing. Venture capitalists who provide equity to my company, Pavan and Company, they become the equity shareholders. In case of debentures, they are called creditors because debentures are credit instruments. So what do you mean by participating debentures? By subscribing to my debentures, venture capitalists become the creditors and participate in the operation of my company as stakeholders, one of the stakeholders. They become the creditors. And I need to pay interest to them because they are the debenture holders. I need to pay them interests. And these interests are collected by the venture capitalists in three phases. In the first phase, I am in the infant stage. First stage is a startup phase. It's an infant stage, starting stage, where I don't have any revenue. I don't cross BOP. Okay, break-even point is not crossed. I don't have any revenue. So I need not pay any interest. No need to pay any interest. This is the first phase. Venture capitalists will not pressurize me in this first phase. First phase might be 1 year, 2 year, 3 years, whatever it is. Okay, that is gestation period. And then next second phase. In the second phase is the initial operations phase. Slowly I am crossing my BOP and start earning profits. In this case, I have to pay low interest. Okay, because I started making profits, I crossed BOP, slowly I'm earning profits, I will pay low interest. In the third phase, I strongly position my company in the market, and my company has grown. It has become a very good company with good market capital in the company. Growth happened in my company. So I have to pay high interest to them. Likewise, I should pay the interest to debenture holders in three phases until I repay the capital. The last one is convertible loans. Convertible loans are the traditional loans. They are called traditional loans, which are given by venture capitalists on the prevailing interest rates. For example, in the market at present 12% is there. I can borrow loan from venture capitalists, and every year I have to pay 12% because it is 12% per annum. Every year I have to pay 12%. This is called convertible loans. Why is it called convertible loans? They can be called traditional loans. The simple funda is, in case if in any year I am unable to pay interest or principal amount, immediately these loans are converted into equity. Try to understand. It becomes equity, and the creditor will become the shareholder. He will become the shareholder of my company, and after the stipulated time, after 5 years, for example, he will double the amount, sell in the open market, he make the profit and leave my company. So this is all about venture capital. So in short, venture capitalists are experienced, expert financing institutes. Always look forward for the creative entrepreneurs who have bunch of ideas like this. They will find out, or these entrepreneurs will find out the venture capitalists. They will have discussion between each of them. If the ideas of entrepreneurs are good, trustworthy, and proven potential growth in the future, they will come forward to finance in the company. For example, my company, I am one of the entrepreneur, for example, and these are the different ways of or methods of venture capital financing. I may take equity financing, I may take conditional loan, I may take income note, I may take the participating debentures, or I may take convertible loans. These are the methods of venture capital financing.